Good morning, everyone. Welcome to Phillip Securities Research Morning Call. For this week, for stock counter updates, we have initiation on LHN Ltd and Phillip on the ground for Valuetronics Holdings, MN2 Asia, Cromwell European REIT, Keppel Pacific Oak US REIT, and KSH Holdings. And for the sector outlook, we have SG Banking Monthly. So without further ado, I will be starting off with initiation on LHN Ltd, which we identify as an optimizer of real estate trends. So to begin, a brief company background first. The company was listed on the Catalyst in 2015, then dual listed on the main board of the Hong Kong Stock Exchange in 2017. They are a real estate management services group with history dating back to 1991. So you can see from the figure on your right, they have three main business segments: space optimization, facilities management, and logistics services. So they derive bulk of their revenue from Singapore. So Singapore contributed to 92% of FY20 revenue. Locally, they manage 31 commercial, industrial, and residential properties, 2 container depots, and 74 car parks as of 31st March 2021. So zooming in on the first business segment, space optimization, this segment contributed to 52% of FY20 revenue. And space optimization here refers to a customized process of increasing the availability of usable space, or NLA. You can refer to the bullet points on the top right. And an example would be that the company, they lease properties from government, Singapore Land Authority, or also private owners like Far East Organization. They take these old, unused, and underutilized spaces, transform and enhance them before renting out to tenants. So under this segment, there are 3 sub-segments: commercial properties, which consist of offices, retail outlets, children's enrichment centers, etc. And the Green Hub, this Green Hub brand of suited offices is under this segment. So this Green Hub, they provide services like, or they provide facilities like your typical offices. They also have hot desking and also facilities like meeting rooms. So for this second sub-segment, which is residential properties, they have the Collywood and 85 Soho brands, which are their co-living and serviced residences brands. So Collywood is the brand in Singapore, while 85 Soho is an overseas brand. So they have presence in China, Cambodia, and Myanmar. The third sub-segment is industrial properties, and the work plus store outlets is parked under this segment. So other than work plus store outlets, they also have other industrial properties. So in total for this segment, space optimization, they generate rental income and also warehousing service fees. Moving on to the next segment, which is facilities management. This second segment contributed to 29% of FY20 revenue. And under this segment, they have 2 sub-segments: car park management, where they basically manage the car parks, they provide security services, and also cleaning and related services, including like your typical pest control, landscaping, cleaning, etc., etc. For the last segment, which is logistics services, LHN provides transportation services and also management of container depot. So for transportation services, they transport ISO tanks, containers, base oils between the ports and different loading terminals, and also customers' designated destinations in Singapore. As for the container depot management, they have a wide range of services such as container handling and storage, container surveying, cleaning, etc. So when the containers arrive at this container depot, they'll undergo the typical surveying to ensure that there are no, they can go on and for their next service. So they will also do the basic cleaning and repair. And they primarily service major shipping lines and container leasing companies. Moving on to the investment merits. First of all, we expect the work plus store outlets to continue expanding with the rise of e-commerce retailers. So on average, the occupancy rates are at about 90% and are up to 70% is occupied by e-commerce retailers. And that includes, retailers who sell like bicycles, baby products online, florists who sell flowers, and these are just some examples. So if you refer to the graph on your top right, you can see that the proportion of online retail sales in Singapore more than doubled from pre-COVID times during like January 2020 of about 6.3% to 13.3% in April 2021. Another supporting factor for this segment would be that the industrial property rents rose for a second consecutive quarter for first Q 2021. So currently, they have 9 work plus store outlets, and there is one upcoming facility expected to commence operations in July 2021, and that is expected to add about 14% of net lettable area NLA to the portfolio. So you could refer to the pictures on your bottom right for an example of a work plus store outlet where the retailers could store their goods. They could do some, simple administrative work. They can pack their goods in this like air-conditioned and also well-ventilated environment. And this picture is an example of a shutter unit, which could be used for self-storage. So moving on to the next investment merit, demand for co-living and serviced residences are also expected to increase sustainably. So under this Koliwu brand, the average occupancy rates are at about 94%. And some attractive points include flexible leases of minimum of 7 days, and also reasonable rentals depending on location and property type. So some of their tenants include white-collar workers and also foreign students. For projects that are in operation as of end of financial year 2020, there were 763 keys, and we expect about 210 keys to be added by end of FY22E. Moving on to the last investment merit. So facility management segment expanded with the acquisition of 33 JTC car parks, which was completed in January 2021 this year. And that brings the total number of car parks to 74 as of end first half FY 2021, which ended in March 2021. So car parks at some of their newly acquired properties will also be managed by the company. And the most recent acquisition under this segment was the car park at Bukit Timah Shopping Centre, which was acquired in September 2020 under a joint venture. So lastly, moving on to the valuation, we initiate coverage on LHN with a buy rating and a target price of 54 cents based on 9.5 times adjusted FY21 EPE ratio. This 9.5 times represents a 50% discount to the industry average of around 19 times. And the reason for that is the lack of valuation comparables due to their very diverse business segments. So in my presentation earlier, I mentioned about they do space optimization, they do facilities management, and also logistics services. And the next reason would be the very volatile historical earnings. So you can see from the graph on your bottom right, the historical adjusted PE ranged from about 4 times to 70 times over the past 5 years. And if we exclude outliers of around above 60 times, it averages at 27 times. So that's all for initiation on LHN. I'll now be moving on to Valuetronics Holdings second half 21 results for the period ended March 2021. This is a Phillip on the ground, and we do not have any coverage on the counter. So for Valuetronics, they are a design and manufacturing partner for brands in 2 segments, consumer electronics, CE, and industrial and commercial electronics, or ICE for short. So you can see from the bullet points on your left here that the revenue and PATMI for the reporting financial period both increased, and on a full year basis, revenue decreased while PATMI increased. Another thing to note would be this dividend yield. So if you consider the total dividends for FY 2021, which is 21 Hong Kong cents, it gives us a dividend yield of 5.9%, which is higher than the 5.6% for FY 2020. This is also supported by their strong net cash position of 1.13 billion Hong Kong dollars, and the company has no bank borrowings. So we expect them to be able to sustain these dividend payouts. even though earnings momentum for the next financial year, FY22, is expected to be much weaker. And this is due to the fact that 40% of their sales are from the United States. But due to the Sino-US trade tensions, there have been loss of orders from customers switching their supply chains to other countries. So an example would be this major customer in the CE segment, which switched supplier. And you can see from the table on your bottom right that the revenue contribution from CE actually fell around 26% for the full year of 2021. Their shift of factories from China to Vietnam is on schedule, and they are targeting to commence production in Vietnam by end FY22, and that is would end in end of March 2022. Yeah, and I will now be moving on to MM2 Asia's second half 21 results, which we attended the briefing for. Again, this is a flip on the ground, and we do not have any coverage on the counter. So for MM2, the revenue for the reported financial period was down, and also PATMI was much more negative at negative 70.3 million as compared to the negative 5 million for second half of FY 2020. And the lower revenue could be attributed to mainly COVID-19 restrictions, which resulted in deferral of movies titles and capacity restrictions that affected their core business and also cinema business, deferment of concerts and large-scale and MICE events that affected their events and post-production segments. So the PATMI was much more negative due to higher impairment losses of around $38.8 million. This was partially offset by the savings in administrative expenses due to cost containment measures, like lower staff costs and also cinema operation building maintenance expenses. If you refer to the points on your right, you can see that the group debt is expected to shrink by over 50%. And this is contributed by, first of all, the completion of the rights issue in April 2021. So 51.8 million of the gross proceeds were applied towards the repayment of the medium-term notes, or MTN for short. And for the IPO of the cinema, if after completion, they are expecting the net debt to shrink further by 80 million. If you refer to the table on your bottom right, from 206 million to around 120 million, with the maturity of the convertible bonds and downstreaming of loan to the standalone cinema. So from there, MM2 is expecting interest savings of about $6 million. Moving on to the outlook for the company. So they are expecting a lot of growth opportunities in their core business, mainly due to their strong pipeline of 26 projects valued at almost 100 million Sing dollars, with earnings visibility until first half of financial year 2023. And they are also targeting 40% of the content production revenue from streaming channels by financial year 2022. So they are working closely with OTT players like your Netflix, Disney Plus, and etc. For the cinema business, the IPO is ongoing, in process, but the structure is still very unclear. And the merger with the Golden Village is also is in the process concurrently. So these two events are not going to affect each other. Another factor for the cinema business would be this backlog of Hollywood titles due to the seriousness of the pandemic situation in the US. So if going forward, we are seeing the release of these Hollywood titles like your Fast and Furious 9, and if Singapore manages to control our pandemic situation locally well, and the government relaxes, pandemic restrictions further, then that would be a recovery for their cinema business. Lastly, on the Unusual side, Unusual is our local concert production company. So they are expecting more online or hybrid concerts, which means both online and offline audience. And with JJ Lin's concert next month as a start. So with that, they are also expecting recovery in revenue for this final segment. So that's all for me. I will now pass on the time to Natalie for Keppel Pacific Oak US REIT.
Thank you, Vivian, and good morning, everyone. So this will be a segment on Keppel Pacific Oak Phillip Underground. So Keppel Pacific Oak is short form for, core is short form for Keppel Pacific Oak. Yeah. Next slide, please. Okay, just as a reminder, we do not have coverage on core. And a bit of a background. So core owns about 13 office assets located in the United States with an AUM of 1.3 billion US dollars. So in the first quarter of 2021, core saw distributable income increase by 3.6% year on year, and they registered positive rental reversions of 5.7%. Okay, so in terms of new leases signed in the quarter, new and expansion leases from tech hubs of Seattle and Denver registered positively on their leasing. And in terms of occupancy, it stands at 91.6%, and this ranges between 72.2% to 100% across their assets. So now, if you look at the map on your right-hand side, Core's assets are located in Seattle, Sacramento, Austin, Dallas, Houston, Orlando, Atlanta, and so a lot of these locations or cities are actually what we know as 18-hour cities. So they are what is unique about 18-hour cities is that they have strong infrastructure and widespread urban development, as well as a lower cost of living. So the affordable housing and employment opportunities, as well as lower cost of living, actually account for what is driving the population growth in these cities. Yeah, so these cities are expected to have experience rental growth as well. Okay. So in terms of outlook, the core has been doing, or rather fully fitting out speculative suites. So what happens is that they actually furnish the space to speed up leasing. So they've done this for about 13 units ranging which are around like 200 to 300 square feet. So typically they know what tenants who look for 200 to 300 square feet of space they look for in their own space. So what they're doing is preemptively they are actually fitting out the space with like your tables and your collaboration areas, so as to speed up leasing. Whenever they have tenants touring through the building, they actually will be brought to these units first to have a look. Yeah, and this has actually done quite well for them. Out of the 13 units they have done this with, 12 have already been leased out. So they will be employing this strategy to some of the other vacancies in their buildings. Yeah, and so that of course will help to speed up leasing. In terms of occupancy, just touching on this for a while there are two assets, or rather three assets, that actually are in the 70% range in terms of occupancy. So one of these assets is actually done. The occupancy was actually lower intentionally. So before COVID hit, they actually bought 1800 West Loop with low occupancy. So the intention was that they will be able to improve the occupancy and lease it up. Yeah. So what they have done is, for example, upgraded the amenities like fitness corners, redid the ground floor restrooms, the lobbies. But however, although the AEI was completed before COVID hit, when COVID hit, of course, that the leasing momentum was impacted, and of course that hasn't yet picked up. So that sort of explains why there's lower occupancy in that particular asset. So if you look at the WALE by CRI, WALE is actually slightly lower compared to the other US office REITs, at 4.5% compared to Manulife and Prime, which is above 5%. 4.5 years, which compared to Manulife and Prime, their WALE is around 5 years, 5.6 and 5.3 years. So one of the reasons for this is because the assets Core's assets are actually located in up rental markets. So the rentals have been increasing by 3 to 5% yearly. and also because of the tenants that they have in their portfolio. Large part of them, about 30%, are tech tenants, which have, very changing needs. So they do not want to be locked in for a very long period of time. And so this actually works in cost favor, because the REIT typically does not want to be locked in for longer periods of time, especially when there's a rising rental market. Because if it's a 10-year lease and your escalations are 2.5%, but compared to the market reversions, which are around 3 to 5%, you'll be under rented at the end of the 10-year term. Yeah, so that sort of explains why their WALE slightly shorter. Next, moving on to Cromwell European REIT. So this is also a Phillip on the ground, and we have no coverage and rating for Cromwell. So as a background, Cromwell has 107 assets and an AUM of 2.3 billion euros across 11 European countries. So the 11 European countries you can see on the map on the right hand side: Finland, Poland, Denmark, the Netherlands, Germany, Czech Republic, Slovakia, Italy, and France. So in terms of asset, 58% of their assets are in core assets. So core assets are stable, mature assets that require very little management, typically like those on very long leases. So they will provide stable recurring income. And there's the core plus assets, which form about 34% of their portfolio. And this requires a little bit of active management, perhaps on shorter leases, where it requires bringing in new tenants to replace the expiring leases, etc., as well as some value add assets. So value add assets are those assets which are typically maybe older and a bit more rundown. So this presents an opportunity for them to come in, do some asset enhancements, and then after that charge a higher rent when you try to lease up the asset. In terms of occupancy, 94.6%, WALE of 4.8 years, and a weighted average lease break of 3.3 years. So distributable income for the first quarter of 2021 was lower by 6.1%. This has something to do with a disposal of 12 smaller high-yielding assets in the Netherlands, France, and Denmark. And also, of course, they did some private placement in the first quarter. Yeah. Okay. What also happened was that on the 7th of May, they did a 5-to-1 unit consolidation exercise. So that actually helped to increase, that helped to reduce the bid-ask spread by 70%, as well as increase trading volumes. So trading volumes increased by, daily trading volumes increased by 1 million euros to 2.4 million euros. So as with a lot of leases, Europe leases, there are rental escalations for the leases in Cromwell's portfolio. So for Italy, the escalations are actually pegged to 75% of the inflation. In Germany, the escalations are done on a 5-year basis based on a 5-year cumulative inflation. And in France, escalations are pegged to construction costs. So the outlook for Cromwell, overall, we see that their office portfolio will face some pressure, and in several of the cities in which they have assets in, there has been a rise in vacancy rates, such as Milan, Amsterdam, and Warsaw. They have about 30% of assets which are in logistics and industrial assets. So the European logistic market has strong fundamentals and low supply, coupled with robust occupier demand, which is driven by e-commerce and online food delivery. So that, of course, is very positive for the logistic assets. Next slide, please. So, of course, just drawing your attention to how the portfolio has changed since IPO. So at IPO, we saw that, typically they had 43% of assets which are light industrial, as well as 47% of assets which are office. And then moving on to now where we are, the amount of logistic assets actually fell slightly by about 5%. No, by about 5%. And office assets increased to 57% of the portfolio. And in terms of geographical breakdown, compared to during IPO, there have been several acquisitions which have sort of increased the diversification, as you can see in the right pie graph, bottom right pie graph. In terms of portfolio targets, they're actually intending to achieve a 75% exposure to Western Europe, and with more than 75%, at least 75% of assets in the office and light industrial and logistics asset class. So actually, in terms of this 75% allocation, 50% of it will be for light industrial and logistics. So they're actually hoping to have a more logistics and industrial heavy play. In terms of leasing strategy, while they have been more flexible in terms of their leasing terms, offering shorter leases and allowing lease breaks within their lease agreements. Of course, they do try to protect themselves, and they typically require a 6 to 12 months advance notice if tenants would like to break their lease. They have also, in order to help tenants with their cash flow, they have allowed tenants to pay rents 1 month in advance instead of 3 months in advance. And if they have to offer any rebates to their tenants, this typically comes with lease extension. Yeah. Okay, so that's all for Cromwell. I'll now pass the time over to Terence for Banking Monthly.
Yeah, thanks, Natalie. In this month's Singapore Banking Monthly, we look at the effect of Singapore's move into phase 2 heightened alert on the banking sector. So in our next slide, you can see the local lending rates actually dipped in May. So this actually reversed their gains in the last 4 months to dip in May, with the 3-month SIBOR and the 3-month SOR falling to 0.44% and 0.23% respectively. You can see this on the chart on your left-hand side. It's a little bit small, but you can see that since January, at the start of this year, the interest rates actually started to creep upwards after being flat for a while. Because of the improving economic outlook, the SOR and the SIBOR actually started to move upwards, but for May, it actually dipped just slightly because of the move into this phase 2. So when we compare the 3-month SIBOR with the first quarter 21 average, this is about still 2 basis points higher than the first quarter 21 average, whereas the 3-month SOR is just 2 basis points lower than its first quarter 21 average. So the effects is really quite minute, but in terms of the trajectory of the rates, we think it will still depend on the COVID-19 situation in the community, and at this moment we still expect NIMs to remain unchanged because of the number of cases currently. In terms of the NPLs or the non-performing loans, we expect this to remain stable even as more loans under moratorium start to decline. So for moratorium loans for DBS and OCBC, this actually declined from 3% and 4% respectively as at end December 2020 to 1% and 2% in the first quarter of 2021. So you can see the loans under moratorium has actually really come down, and for the rest of 2021, we expect the rest of the loans moratorium to just roll off already. But we separated UOB's loan moratorium because for UOB, the way they classify the loans moratorium is a little bit different. We listed it down. You can see here loans under government relief, bank relief, ESG loan schemes. So this, for them, they categorize this under this category, but it's actually just 5% of his loan book in the first quarter of 2021, down from 9% in December 2020. So it's higher than DBS and OCBC, but also for the trend is that it's expected to go down for the rest of 2021. So even as the loans under moratorium roll off, we expect the NPLs to be stable because the asset quality is pretty stable. In our next slide, we show some of the summary of the bank's key operating metrics in first quarter of 2021. You can see this on the table on your left-hand side. So we did a comparison quarter on quarter because it's more meaningful for some of you wondering, versus comparing year on year, because year on year it won't be very meaningful. So NIMs, you can see for the NIMs across the three banks, the NIMs was unchanged for first quarter of 2021 with DBS 1.49%, OCBC 1.56%, UOB 1.53%. So we actually see the NIM stabilized in the first quarter of 2021, with the net interest income generally stable across the board. So for full year 2021, despite the current economic outlook, we still expect net interest income to grow about 5% year on year across the three banks, and for the NIMs to remain stable. But for us, the standout performer was really net fees and commissions. This is on the third row here. You can see for net fees and commissions, it grew the most, especially with DBS and UOB. Their net fees and commission actually grew 28% for DBS and 22% for OCBC. So double-digit growth across the board for all three banks. So for full year, we expect this the overall income to be lifted by this segment here as well. And in view of the improving economic outlook, the banks actually eased the general provisions or GPs during the quarter. So you can see on the fourth row here, the general provisions actually decreased across the board, especially for DBS and OCBC, and also even UOB. They decreased the overall general provisions made. But DBS is the most aggressive in reversing some of these provisions. You can see for DBS, they are the only bank that actually reversed out $190 million of provisions that they made in prior quarters. So we believe this is a very strong signaling effect that they've actually already made sufficient provisions already in the previous quarter. As you guys know, the banks are very conservative. So for 2020, they already made very, very huge provisions in 2020, a few $billion in provisions in 2020. So really the NPA coverage, so you just see two columns down, the NPA coverage for DBS now stands at 109%, OCBC 118%, UOB at 112%. So the NPA coverage is just over 30% above the MAS regulatory limit. So we believe, in light of this, we believe there is really further room for GP reversions in 2021. Let's just bring attention to OCBC here as well. You can see for OCBC, for general provisions, they actually only just made 9 million in GP for first quarter of 2021. This really is a signal that they have done. They feel that is already sufficient. So when you in the last row here, when you look at the CET1 ratio, the Common Equity 1 ratio here, 14.3%, 15.3%, you can see this is really way higher than their historical CET1 ratios. So we elaborate a little bit more on this slightly later. So we go on to our next slide to summarize some of the domestic banking loans in April. The domestic loans growth rose 0.4% year on year in April. This actually tracked below our expected range of 2 to 3% for 2021. The main drag was because of business loans, which contracted 1.4% year on year in April for the 8th straight month as loans demand from manufacturing, transport, storage, and communication and business services dropped. So you can see on the table here on your left hand side. Sorry, it's a little bit small, but you can see the table here on your left hand side at the bottom. What we did was we showed the loans growth on a month basis. We think month on month is more useful because if you look at on year, the numbers are, because of the steep drop last year, so it's not accurate. But you look from a month on month basis, you can see that April is actually the slowest in 2021. So for Jan 2021 is 0.72, 0.46 in February, and then 0.65% in March. But you can see April is actually it really dropped to just 0.14%. So this is a bit of a concern, and we'll be monitoring this. But the one that really lifted it up was consumer loans, up 0.3% year on year in April for the 9th straight month. This was aided by loan demand recovery in the housing segment. So the housing segment is the largest loan segment for the consumer loans, are typically taking about 2/3 of the consumer loans. So it's very significant. So because of the very strong property market, the consumer loans in this segment also actually increased. Overall, loans through the DBU or domestic banking unit, which captures the lending in all currencies but mainly reflects Singapore dollar lending, rose 0.1% for the 6th consecutive month, but slower than the 0.7% increase in March. In our last slide, on the next slide rather, on the banking sector, the volatility actually rose because as Singapore entered phase 2 heightened alert. So the securities daily average volume, the SDAV, actually grew 5% year on year to 1.579 million in May, reversing its 3-month decline as Singapore moves towards this phase 2, which elevated trading. So actually, you look at SDAV here, you can see actually for since February, the securities daily average volume has been decreasing. So you can see for February, negative 1% year on year, March negative 26%, and then April also is a negative. But in May, it actually reversed out this negative territory, and actually there was actually more trading actually, because again this rise in the trading volume is because of the move into phase 2. So the VIX, or the volatility index, actually averaged 19.8 in May, rising from 17.4 in the previous month, again because of the COVID-19 community cases. For our last slide, we talk about our overall recommendation for the banking sector. We maintain overweight on the banking sector. The reason is because even though we note some of the concerns, because even though the share price for the banks have risen a lot, but we see them trading close to or below our price to book targets of 1.17 times to 1.36 times. In the past, historically, they've traded above 1.4 times price to book in the past 5 years. So we put this chart here on the left hand side for you to just see how they've traded historically from a price to book basis. But really the reason why we are still bullish on the banks is because we see two main catalysts. The first catalyst is the improving ROEs for financial year 2021. So the ROEs is set to improve because obviously your NIMs have stabilized, your fee income is going at double digit, and also the third reason is your general provisions that the banks provided for, as set as buffers for last year 2020, is actually seen now is more than sufficient than what they require, above the regulatory limit. So it's likely that the banks will reverse out some of these general provisions. So when they reverse out these general provisions, your net incomes will rise, and your ROEs will also be lifted up. The second reason is what we think, the second catalyst rather, we think is once MAS lift the dividend restriction cap on the banks, the banks will likely resume the paying out of dividends back to the pre-COVID-19 levels. So we'll see dividends, a bump up in the dividends, but we also believe that there'll be a special dividend payout, which is likely to maintain their ideal capital structure. So just to go back to the capital structure, the CET1 ratio based on the first quarter 2021 results is 14.3% to 15.3%, which is higher than their ideal range of 12.5 to 13.5% operating range. So because the CET1 ratio is so high, we believe the banks, even if they resume the pre-COVID-19 dividend payout, the CET1 ratios will remain elevated. So to bring it down, they will likely have to pay out a special dividend. There's different ways in which they can pay out. We think they will likely they can pay out in one, that's one special dividend payout, or they could split it into two depending on the economic situation. So they pay one special dividend probably this year and then another one next year. So the manner in which they pay out is not certain, but we believe the special dividend is a very, very high likelihood. Also to just why they will pay this special dividend, because if your CET1 ratio is very high, then what happens is that your ROE will fall. So they will really need to pay out this extra cash, which is a good problem on their books in order to live up their ROEs. Overall, we've provided in this, also on the table on your left hand side, we provided our target price and the forward price to book targets for the three banks, for DBS, OCBC, and UOB. You can see this in the last row here, our target price. Amongst the three banks, we have a accumulate rating, a buy and accumulate rating across for all three banks, but we prefer OCBC in the sector because we expect the faster booking of earnings growth from the wealth management and insurance franchise. So that's all from me for the banking sector. We next cover KSH Holdings, which is a Phillip on the ground. This is non-rated. So the reason why we cover this kind of companies, Phillip on the ground, because we sometimes we attend these kind of meetings and we just present a summary of this, but it doesn't mean that we just don't cover them. So for the business overview, they are in three segments. Just briefly, they are in construction, property development, and property investment. So for construction, they have this BCA A1 grade. And so what this BCA A1 grade means is that they are able to tender for public construction projects of unlimited value. So they can tender for very, very large construction projects of basically unlimited value. In terms of property development, there are 19 development projects of residential, mixed development, office, and commercial. And then property investment, they have investments in China and Singapore as well. So for financial year 2021, they were adversely affected by COVID-19 like all others. The group suffered a loss of 3.8 million for FY 2021. The reason for this loss is because of this loss and impairments relating to the valuation of their hotels and investment properties amounting to 12.8 million. If we exclude this impairment, however, the group's net profit will be $9 million. For those following the construction sector, the group also noted a slowdown in the work progress and increased cost of construction, even though the construction order book is at a 5-year high of $620 million. For our last slide on KSH Holdings, also some sales progress of their residential units. You can see here we provided the total units launched for sale in Singapore during FY 2019. They actually launched 3,450 units, but the total units sold in Singapore as at 31st March, just 3,180 units. So actually not too bad. And if you look at some of their projects that they've launched, for Affinity, Riverfront, Park Colonial, and Resi, most of them are near fully sold, almost fully sold, except for Affinity, but the rest are almost fully sold. So and also for the group's overseas project, the phase 1 of the stage 1 of residential project in Gaopeitian has been well received by the market with more than 530 units sold to date. The group's attributable share of progress billings amount to more than $460 million as at 31st March 2021. So this progress billing is good because it can help to support the group's revenue and earnings for the next few years. So in terms of outlook, with the pipeline supply for private residential market, excluding ECs at 48,131 units, this is actually down from the 49,307 units last quarter. So the inventory is actually lower. So the group is confident in the prospects of this segment. Yeah, so that's all from me. We'll probably take questions now. Thanks so much.
Perhaps I'll take a few questions first for the technical section before I pass on my time to my colleagues. So yeah, okay, let me just okay, so I will just move on. Okay, so let's let me share the screen. Okay, so yes. Okay, so yep, you can see my screen. Just raise up a hand, and then I'll just go on. Okay, so first up, I think I read through all the questions, most of the questions, all right, and then due to time limitation, I will only answer these few questions because I will have to take my leave to prepare something later on. All right, so for Capital Land Integrated Commercial Trust, C3ADU. I'm still on the bullish upside. So as you know that I've recently released a technical report on C3ADU. So it's on Stocks BNB. So you kindly go there for a look. You want to understand more. But it's still on point. It's met my target price for the first target price, I think. So ultimate my higher level target price will remains at $2.22 to $2.26. All right, upside is still ongoing. You can see that this is a bullish flag, and then you have broke off the immediate resistance zone. All right, so that's all for Capital Land. Then next one will be land lease. Land lease, right? For land lease, I'm still bullish, but you can see that momentum isn't that strong. So if I'm going to subdivide it into the this area, you can see that my target price is actually way beyond at 0.008. So which kind of confluence with my target resistance zone back the report which I wrote back in January 2021. So those who are interested, that is still valid. Hasn't hit any stop loss. Yeah, so we can just go and take a look for land lease REITs. Okay, so next one will be SunPower. SunPower is facing although a strong bullish momentum today. So I expect it like last week I mentioned, SunPower did have a breakout. So if this bullish momentum can be sustained above the major resistance zone, above $1.03, then we can see that this pennant, the ABC, most likely is being completed already. So yeah, that's my view. All right, SunPower on the weekly chart, you can see that yes, is still on a very strong upside for now. All right. Okay. So next one will be QNM. QNM, slightly bearish on it, despite on a very strong uptrend, because of the major what you call it, bearish divergence, and then you can see that there's a mini divergence going on right now. So any price on the upside will likely to face much more resistance going forward. Okay. So QNM, I would say that the correction mainly will be at around 0.640 or slightly lower to around 0.580. Okay. So next one will be the Hang Seng Tech Index, Lion OCBC Hang Seng Tech. Hang Seng Tech is still facing some sort of a sell down. This is a falling wedge. So hence I believe that since it fails to close above the resistance zone, and this look like a dark cloud cover or harami, we like to call it. Basically, it's not really a pattern, but the successful sell down will cause much of a rebound at around $1.235 to 1.279 region. All right. Okay, so the next one will be Mapletree North Asia Trust. So Mapletree North Asia Trust, the upside has really hit my target price. Despite some form of correction back to the lower part of the ascending triangle, I still believe that the upside is still ongoing. So preferably, if you look at the larger time frame, I'll be looking at a longer time frame of $1.26 to $1.20 target price. Eventually. Okay, so this what I have in plan for mine in mind. All right, so that's for Mapletree North Asia Trust. Next one will be REIT Global. So REIT Global has been ranging for a very long period since last year. So theoretically it has been ranging for a period of 1 year. So hence I would say that I do not have much view on REIT Global for now. Then ISDN, someone asked ISDN, as usual, my move still remain the same. Ichimoku is showing a ranging market, so hence I hope that price will actually revert back to 0.415 to 0.445 because of the slow momentum. So it may actually rebound at 0.575 as well. So I kindly take a look out for this price level that I've mentioned. Then lastly, Jaffa, I'm still remain bullish despite some form of consolidation and correction. So I'll say that Jaffa will actually have a slight fall today for the next three daily period before a rebound back to the upside and the support zone. Okay, so this support zone one at 0.81 to 0.835 will likely be the best target, best rebound zone before it embarks to break the resistance zone. The resistance zone is supported by the multiple testing of the zone, and therefore I think is kind of like weakened right now. Furthermore, is being further enhanced by the bullish flag. Then lastly, I think is the LHN. LHN Morningstar has a very strong gap up today. if it successfully close above 0.320, then we can say that safely LHN is likely to be finding breaking out of the tenant, this tenant, I would say. All right. And then lastly will be JD Health. JD Health, I would say JD Health is still on the downside, despite because why? First of all, the smaller inverted head and shoulder did not reach fully at at the 1:1 at 139. So hence the forced breakout, the limited breakout pushes price downside. So this has really become an impulse bearish downside already. So if you look at the Fibonacci extension, I will say that it is likely to go to $63.10 for now. All right, that's a long-term target I'll be looking at. All right. Okay, so with that, I end off my presentation. So any question, just send an email to me, or yeah, it depends. Okay, so I shall pass my time to my colleague. Thank you very much.
Okay, hello everyone. Yeah, so I will take the question on LHN. Look for the question first. Just a moment. Okay, so the question is LHN in the same business as REITs? And could you share with us what is behind its high debt to equity ratio of 136.55%? Yeah, so LHN is not in the same as it's not the same as REITs. First of all, because REITs, they own the properties, then they rent out to tenants. But for LHN, they call it an asset-light business model, whereby they most of their properties are on master leases. So they rent these properties, they lease these properties either from the Singapore government, like your Singapore Land Authority, or other private owners like Far East Organization. And with that, could you share with us what is behind its high debt to equity ratio? So for this question, right, actually they adopted this new accounting standard, which is called IFRS 16. IFRS means International Financial Reporting Standard. So with this accounting standard, last time companies could either recognize finance leases or operating leases to their discretion. So for operating leases, it remains off the balance sheet. So you don't recognize assets. There is no liabilities recognized also. So your balance sheet remains very light. But with this accounting standard, they don't have this choice of either finance or operating leases. Everything has to be under everything has to be under finance leases. So in their balance sheet, if you look closely, last time there was this line called finance lease liabilities under non-current and current liabilities. But now everything is grouped under this new line called lease liabilities. And due to the adopting this new accounting standard, over 100 million of lease liabilities were recorded from 30th September 2019, which was FY 2019, to the beginning of FY 2020. So that's the reason for its high liabilities. Yeah, and to add on to the question of whether they are same as REITs. So for REITs, they rent out their spaces to businesses, and for LHN, they lease these spaces, then they rent out to not businesses, but more on B2C, so customers. For example, your work plus store is your you could rent these spaces for self-storage, like for your own use as individuals, and also for e-commerce retailers, like the very micro SMEs. So let's say they start up their own business at home. It was a home-based business in the past, but now they think that they need more spaces to store their goods. So they will rent a very small space, like the one that I shown in my presentation slide earlier. And then for Collywood, they rent out these spaces to tenants who are looking for spaces to stay. So for example, you have your foreigners who are white collar workers, and also foreign students who are looking for places to stay. So most of it on average is about tenancy is about 6 to 12 months for that. Yeah, so it's more of B2C, and as for REITs, it's more for B2B. Yeah. Hope that helps, and I think that's all for now. I'll pass on the time to I think Natalie. Yeah, thank you.
Hi, good morning, everyone. I'll take the question on what is your outlook for Keppel Pacific Oak REIT going forward? I mean the occupancy rate. So I think pre-COVID the occupancy rate was actually around 94%, 95%. Of course, now it's 91.6%. I think the portfolio has experienced a little bit of non-renewals. However, I think because of the location in the tech hubs of Seattle, Denver, and yeah, so because of their location in these 18-hour cities, and which are also like tech hubs, the outlook is a little bit more positive. In general, some of the real estate consultancy agencies like CBRE and JLL, they have noted that leasing has been driven by tech companies, and they have been the ones with the stronger reversions. That means they are able to pay higher rents. Yeah. So in terms of rental outlook, it's slightly more positive. Yeah, when we're talking about new leases signed and expansions. Okay. There's a question here on outlook for Keppel REIT and Keppel DC REIT. Just give me a minute. Tim, if you want to take the one on SIA, you can go first.
Yeah, okay. There's a question about the SIA's MCBs. Paul is not here today, so the question is, can you give your view on SIA's rights issue of MCB? And if you are, and MCB stands for the mandatory convertible bonds. And if you are entitled to this rights issue, would you disregard it, as the airline sector is very cyclical? So right now, okay, the MCB is just another way to play on SIA's recovery. So if you look at it from a bonds perspective, it gives 0 coupon, and it only matures about 9 years later. So from a bondholder's perspective, also the yield is not confirmed. The yield is not guaranteed because it depends on the share price 9 years later. So if you think about it from a bondholder's perspective, it's not really that attractive because you get no coupons until the maturity date. Although SIA has the option to call back the bonds anytime, every 6 months, and they'll pay you in cash for it. So that can be a good thing for bondholders. But from a shareholder's perspective, it can be quite attractive, given that not only does it give you the higher returns from the 6% yield that this bond gives every 6%, but it can be a leverage play on SIA's recovery, because these MCBs may track the SIA share price when it goes up, because it's a convertible bond, so it converts into shares. So it can track the SIA share price, and because this MCB is only priced at $1, the returns you get from this MCB can be more magnified compared to the SIA share price itself. So given SIA's outlook for the aviation industry, so what they say is that they expect to be back to full capacity, back to close to pre-COVID levels by 2023. So if you want to play on the SIA's recovery, the MCBs can be a good way to play on the recovery of SIA. So given that it's cyclical, it can be a good thing also, because on the up cycle, when everything is starting to recover, the returns can be much higher for the MCB. I hope that answers the question.
Okay, maybe I'll take the second question on LHN first. So this attendee is asking if there are any close competitors to LHN. For this question, right, there are actually basically no close competitors per se, because they have competitors in their individual business segments. So in my presentation earlier, we mentioned about the space optimization. They are in the rental property market, property rental market, and they also are in facilities management and logistics services. So in the individual segments, they do have competitors. For example, if we talk about the residential properties, then you have your, foreigners could choose to rent condominiums or HDB if they want to, but then there is a minimum rental period of around 3 months by the due to the government regulations. So that as for LHN under Koliu, their minimum rental is of 7 days. So that is like a competitive factor. That is an advantage for this segment. Then if we talk about, like, let's say, their logistics segment, then they have competitors like your GKE Corporation or Vibrant Group. But then again, these companies are very they are very specialized in warehousing and logistics. So it's I would say that they don't really have close competitors for the company as a whole. Yeah, hope that helps. Thank you.
So I'll take probably just try to clear some questions in the queue. There's one question here. Why is the rationale of covering the stock but not rating it? So the reason why we sometimes present these stocks, we actually tag it very specifically under Phillip on the ground. The reason why we cover, but then we refrain from making a call is because sometimes we get invited to. Most of the time we get invited to this kind of results briefing, and so we know that some of y'all may not be able to attend some of these briefings, so we attend and then we just provide a summary. But because of also internal resources, we may not be able to cover every single stock. So sometimes because of resource allocation, we don't cover the stock, but we still want to provide you a little bit of background with regards to the stock. So actually, if you got more specific questions regarding the stock, you can ask us also. We can see how we can answer. It's just that we may not have performed a deep dive into the company, but if it's something that we know some of the more common stocks, then we may be able to provide a view. So thanks for the question. There's one question on the banks as well. So there's three questions in this. So I'll read out one at a time and then probably just answer them at one. Then I'll move on to the next question. So on banks, any reason DBS and UOB's net fees or commission is much higher than OCBC? Yes, because actually you cannot compare just across the board. This is a very good question also, because for DBS and UOB, they classify the net fees and commission all under the non-interest income, whereas for OCBC they also have under non-interest income, they also have the insurance business. So if you have to include if for OCBC we don't show the insurance business, that's how in our comparison slide. But if you include the insurance business, then you will see that the non-interest income is actually also a lot higher, or actually in line with the DBS and UOB's net fees and commissions. So that's the difference. Is it second question, is it contribution from IB or stockbroking? No, the contribution for net fees and commission, no, sorry, I beg your pardon. There's contribution from IB and stockbroking, but the reason for the bigger bump is because of the wealth management fees, and also because of card related, which means your credit card spend, which really gave it the bump. So there's one last question here on special dividend payout. which banks will be favored to pay higher? Now, this is a very, very tricky question also, because this is dependent on when the MAS will lift the regulation, lift the dividend cap imposed on the three banks. But amongst the three banks, UOB is the one that pays out based on pay out their dividend based on 30% of their overall net earnings. So if they remove that cap, and you see UOB actually reversing some of their earlier provisions, then the quantum of the payout is likely to be higher, but just purely because it's 30% of the net income. But overall, across the board, we think, because most of their CET1 ratios are also very, very close, so about 15%. So the quantum and the payout, we believe, is largely going to be largely similar across the three banks. But if we have to just choose, it's probably UOB. Yeah. I'll just see whether there are any more banking questions before I hand back to my colleagues. There's one question on the G7 minimum tax. So I'll probably try to answer this as well. The G7 minimum tax, any impact on companies listed here? So just a little bit of background here. Thanks for the question. Of course, the G7 countries recently just passed the G7 minimum tax, which mandates a 15% tax rate on companies that they have to pay regardless of where they are geographically located. But the issue, I think obviously this is good. This will likely have an impact on some of the companies that are here, but the manner in which they would implement this and the timing in which they implement this is also uncertain, and they actually left it out. So I think while we believe there'll be some impact, but it's also a bit too early to comment on this impact, and whether it will come to pass is also another thing altogether. So we probably don't really have a view at this moment. Yeah, so that's all the questions I have. I'll hand back to my colleagues. Thank you.
Okay, I think I will take another question on LHN. So this attendee is asking, what's LHN's exposure in Myanmar? Okay, so thank you for the question. So percentage-wise, right, for FY 2020, the contribution of revenue contribution from Myanmar is around 1.2%, so it's very minimal. And to elaborate on that, in Myanmar, they have two co-living service residences kind of buildings, properties. So they have this, under 85 Soho, they have two properties with capacity of 29 and 88 units over at Myanmar. But we don't think the LHN as a whole will be impacted by the situation in Myanmar, mainly because with the situation, I think they would more likely be just staying in. So the rental rates wise, I don't think that is going to be impacted. Yeah. Thank you.
I think I'll take a few more technical questions. I think, okay, so first of all, I'll go through venture and then Keppel Corp. So how about I go through Keppel Corp? So yep. Okay, so Keppel Corp, like what I've mentioned, that I'm still waiting for the upside to come down to $5.10 before rebound. So because this is traditionally a confirmation of a five-way triangle, but no doubt wave D might eventually be broken, may potentially be broken and then move on to $6.10 to between $6 to $6.10 target price eventually. So right now the momentum remains strong. Okay, so I expect some further upside to target for $5.48 to $5.56 for Keppel Corp. All right. So next one is venture. So venture do have expect some V-shaped recovery, especially today it has a bullish candle that is on the upside. So, but the question is $19.30 to $19.50 is going to break. So if it's going to break, then I'll expect our price to go back to $20.24 to $20.50. And then venture is going to, I believe venture is going to range for quite a period of time. All right. Oh, the next one is, I'll share the banks, a bit of the banks. So UOB and OCBC remains quite strong, and then OCBC have released a report. It's still currently on track, on the positive track. So for UOB, this is like a V-shaped recovery, and then if you look closely, there's like a bullish flag going on. Okay, but momentum remains slightly weaker. So hence, the support remains over here at $25.38 to $25.68. No doubt, long-term trend is going to break this resistance zone. As you can see that I shared before that this weekly, this resistance zone has been tested multiple times. So hence, I believe that the upside going to target around $30 it will be there. All right, and then you can use a large Fibonacci extension. I can see that 1.618 $20.55 has yet to be met. So this is the minimum target I have for the over the long run. So look on to 011. 039. So for OCBC, same thing as UOB, you can see that there's a bullish flag going on. All right, so largely the price structure and the technical structure don't change. It's just that OCBC have really much more room to grow until $14. And furthermore, it has already broken out of the downtrend line successfully. I think this is like we are reaching 2. So, but I think that this will be extended wave 3. So we'll be targeting $30.39 for the over the mid to long term plan. All right, lastly, the last 2 stocks I'll be sharing a bit of Hong Kong stocks. I'll be on BYD Cars is a car manufacturer. So there's some sort of consolidation, some upside. The upside was more than what I have expected. So hence, I think that this will not be fulfilling. But do note that this resistance zone remains a very strong threat. All right, so if it does not break this resistance zone, then my view of the prolonged range is going to be happen. All right, even if it breaks it, I think the next one at 240 to 252 will likely be the next major sell down event over the long run. All right, Xiaomi is after breaking the ascending triangle, the momentum is pushing past prices down. So I'll be looking at $26 whether it be supported or not. If it's not supported, then we will be looking at a further downside at $22.50 before a rebound. All right, so I think that's all. I think there's so much question that my colleagues are waiting to answer. All right, so I'll pass back my time to my colleagues. Thank you.
Okay, Tihyo, you can go first.
Okay. I think we have 2 questions on land lease. So the first one is, what is the impact of the 30% acquisition of GEM? And secondly, what do you have any comments on land lease? So land lease actually just announced an acquisition of additional stake in GEM just this morning. The acquisition is expected to increase LREIT's effective stake to up to 31.8% post-acquisition from the 3.75% previously held through their 5% stake in the AV fund that holds 75% of GEM. So this acquisition is expected to be funded using cash, debt, and proceeds from their 200 million perps that they just issued last Friday. And so that as in all, I think there are three main merits. The first one being the acquisition will increase their portfolio AUM by 18%, which actually provides portfolio diversification from the 313, which is actually more impacted by COVID-19. Also, they'll be adding another additional resilient suburban asset that is actually performing better than neighboring malls during this phase 2 heightened alert. Secondly, this acquisition is expected to be DPU accretive. Pro forma numbers are expected to be lifted by, I think, 3% based on 1H 21 numbers, and also 3.6% on the full year 20 basis. And also from the analyst call, we also note that there may still be further upside to the 3.9% MPI yield that was guided, since this is actually calculated based on what's forecasted for the end of this year. And this actually includes provisions, bad debt, and also rent waivers, inside this MPIU. So moving forward, it's likely that the future MPIU for this property can be higher. And then I think lastly, this acquisition actually is expected to make LREIT the biggest stakeholder in GEM. We do believe that LREIT will continue to acquire more stake in GEM in due time. So I think all in, I think this acquisition do bode well for LREIT. And in terms of our call, we haven't factored the acquisition in yet. So our target price is still under review. Yeah. So this is all for land lease. Back to you, Ned.
Hi, thanks, Jie-Hui. Okay, so I'll take some questions. What's the outlook on Keppel REIT and Keppel DC? So for Keppel REIT, for those of you who know, they are still pending the completion of one of their assets. I think it's Keppel Bay, something like that. It's at near Vivo. Okay, so that will come in close to, I think, 3Q. Apart from that, when we look at it from a macro point of view, we see that in the first quarter there has been a pickup in leasing renewals for Keppel REIT, as well as in the Singapore market as a whole. And in terms of your CBD core rents, they have actually held steady, and meaning it's, according to CBRE, is about 10.40 per square foot. Keppel managed to register positive rental reversions, 10.4%, and they didn't really witness any downsizing, except for the banks. So the banks were the main tenants that were downsizing, and in terms of the leases signed, it was still based on like a 3 to 5 year kind of lease terms, and not really on a shorter, like 1 to 2 year kind of lease renewals. So of course, that being said, despite the occupancy being high around 96%, we still think that there might be a bit of pressure for the Singapore office market, due to some occupiers still try to make up their mind on their working arrangements. Yeah, so that's for Keppel REIT. For Keppel DC, so I think I mentioned this a few times. So our target price is $3.20, and this actually incorporates 500 million worth of acquisitions, or rather data center acquisitions. So all in, the DPU for first quarter 2021 actually rose by about 18%, slightly aided by a small acquisition of Amsterdam data center, as well as their contribution from Kelsterbach, which was done earlier. And a large chunk of this improvement in DPU actually came from the AEIs that were done by the REIT. So they did several AEIs, some of them to bring on additional power to their data centers, some of them to convert non-data center space to data center space. So that actually resulted in quite a significant uplift for their portfolio. In terms of their Singapore portfolio, that is where a lot of these AEIs were done, as well as in Dublin. So Singapore portfolio is pretty much efficient. They do still have opportunities to convert some of the this asset, which is DC1, leased out to MediaCorp. So it's a 7-story asset. Two floors are now fully fitted, and there's still opportunities to convert 5 other floors, and sign them on as fully fitted so that they can, charge a higher rent by providing, the machine and equipment, etc. So that is for the Singapore side. In terms of acquisition, this is where we are seeing a little bit of difficulty. So all along, the only way for Keppel DC to grow significantly would be through inorganic acquisitions, and due to the increase in competition for data center assets, this has actually compressed the yields for data centers by about 50 to 70 basis points just over the last year, and that means that the yield, the NPI yields that we are looking at is now anywhere between 5% to 7%. So the competition has pushed up the prices and also sort of taken out some of the yield accretiveness from data centers. Yeah, so that is also posing as a challenge for Keppel DC. Recently, they actually announced an expansion of mandate where they are now also looking at acquiring, other assets that are packaged together in a portfolio with data centers. So that could be like, that could include, infrastructure kind of assets like your telephone towers. And basically the reason for this expansion of mandate is because when they were out in the market trying to look for more data center assets, a lot of sellers, they actually package their data centers together with other infrastructure kind of projects, and those are projects that, of course, assets that will support like the digital landscape as well. But because of their mandate, they were unable to pursue these kind of portfolio acquisitions, and it also prevents sellers of portfolios from actually actively looking up Keppel DC, and presenting the portfolio. So, hopefully with this expansion of mandate, it will sort of accelerate the acquisition timeline. But that being said, Keppel DC is going to remain a data center operator. They will not be taking any sort of operating risk in relation to non-DC assets. So if they were to acquire any infrastructure related kind of assets, it will be strictly on a hands-off basis, meaning it's going to be like a master lease or something along those lines, a triple net lease. Yeah. So that's about it for Keppel DC. We still expect some acquisition to come through, and based on our 500 million acquisition assumption, we're actually slating that for the fourth quarter of 2021. So we still have another about 2 months, two quarters for the acquisition to materialize. Yep, so that's all for me. Okay, there's another question here on the Maple rights issue. So actually, I think we did the calculations last week or last week. We saw that in terms of the offer price versus the TERP price, which is the theoretical ex-right price, the offer price actually still offers a discount to the TERP price. So for a discount of about 4%, if I remember correctly. So for existing unit holders who have the option or the to actually subscribe for this preferential offering, you might actually find some value in it, given that currently you can subscribe to the units at below the TERP price. Yeah. Okay.
I'll just take the questions on the SIA MCBs, couple more. So does the SIA MCBs give annual returns like normal bonds? So yes, there is a return that you will get from the MCBs. So if you hold the MCBs until maturity, you get 6% per annum. But if SIA chooses to call it back earlier, then the returns may be lower. So if they choose to call back between years 1 to 4, then your annual yield will be about 4%. From years 5 to 7, it will be about 5%. Then the rest it will be 6%. But note that these are zero coupon bonds, so you only get a return either when they call back the bond or when the bond matures. There's no like interest payments every month, every half, annual or annually, as such. The next question is, SIA MCB, will you lose your capital if there's a default like high flux? Yes. So you will lose your capital, but the difference between SIA and high flux is that SIA is backed by the government, by the Ministry of Finance. That's why the bonds for SIA trades at investment grade levels.
Hi. So if there's no further question, we will end the webinar right now. So unfortunately, I think due to time constraint, as I have one more webinar at 1 p.m., we need to prepare for it. So we will technically end the webinar right now. So any question, just go drop by our Stock BNB page and then or write an email to us. All right. So see you all and have a great Monday ahead. Thank you.